Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White, and as our lead-in indicated, I'm a securities attorney that represents investors in claims against their brokerage firm, so that we'd call this sort of a different take on an investment show. I'm not a financial advisor. I'm not here to give you investment advice or to suggest that you buy XYZ stock or sell this or anything like that. Instead, the objective is to sort of arm the investment public with some of the information that I've picked up in my years of representing investors, with the hopes that some of that information will improve their relationship with their financial advisor, get them asking better questions, and get things more in balance so that we can hopefully avoid situations where you would need me. And so that's the goal each week, and we'll try to tackle different topics as we go along. And the topic we're going to talk about this week are FINRA statistics on the types of claims being filed, the numbers of cases being filed, etc. Because I think there's a lot of takeaways that you could take from that, both in terms of what kind of things should I be on the lookout for, what types of fraud is out there, when are claims being filed, etc. So if you don't realize it already, either from listening to the show or just from your own general knowledge, FINRA is the regulatory body for the securities industry here in the United States. They are paid for by the industry, but in theory are supposed to be independent in terms of their regulation of the brokerage industry. And any broker-dealer in the United States is registered with FINRA, and so are their employees. So there's a regulatory function that's separate and apart from what I do and what we're talking about here, but they do have a regulatory component, not unlike the SEC, where they step in and investigate brokerage firms, they audit them, and they can impose sanctions and fines and the like. They also have an arbitration portion of FINRA. That's the part that I deal with, because whether or not you realize it or not, when you signed up for a brokerage account here in the United States, I would say 99.99% of the time, buried somewhere in the fine print there of that agreement is language that says if you have a dispute with us, you agree to waive your right to sue us in court, and instead you have to bring that claim through FINRA arbitration. It used to be called the NASD. And so that's why all of these claims that we deal with in our practice, or any claim that you might have with your brokerage firm, is going to be a FINRA arbitration claim. And again, that's why those statistics will be relevant in terms of discussing, okay, if that's where these disputes are heard, then what are the types of claims that FINRA sees, and what are the statistics? Because one thing they do a great job of is publishing their statistics and giving you sort of a snapshot of what's going on right now in FINRA arbitration. So the basic takeaway, I think, generally speaking, from FINRA arbitrations and the numbers of claims that would be filed, is that FINRA arbitration is very much counter-cyclical to the market. And I think this intuitively makes sense in terms of, when would you even conceive of bringing a claim? And so when the markets are up, generally people are either happy with their financial advisor, maybe they're not happy, but they're not so mad that they're going to do anything about it. And I think this past year is a perfect example of that, and it's borne out in the current statistics. The market was up approximately 30%, depending on which index you want to look at. But I think that's the basic number for the S&P. And so if the market's up 30%, and let's say your financial advisor has a poor strategy, because of course the reality of investment fraud, negligence, et cetera, is all these things are happening all the time, regardless of market influences. But they're usually flushed out when the market corrects, because that's when you become aware that maybe you've got a bad strategy. And again, it's borne out when you see the market clipping along like it was last year. Market's up 30%. Let's say your broker has a poor strategy and you're only up 5% or 10%. You might be a little peeved, but you're not necessarily going to do something about it. You're not necessarily going to call a securities lawyer or investigate or figure out if there's some claim that you should bring. It's typically going to happen when the market's down maybe 10, 20% and your portfolio is down 50. And that might raise some eyebrows and get you thinking, what went wrong here? Why is my portfolio doing so much poorly than everybody else's? And again, so that's borne out in the most recent statistics that were published by FINRA in terms of just the sheer number of claims being filed. And the most recent statistics were published in September of this year. And they have that so far this year, about 2,500 cases have been filed, which is a 14% decline from 2014. Makes sense. But more drastically and more in terms of a highlight of that particular point is that the claims are down dramatically from what we saw after the Great Recession, 2008. I think the claims in 2009 were about 7,000 cases were filed. That was the peak year. But even in 2010, 2011, you were seeing 5,000 plus, 4,000 plus cases being filed. And now you're down to, about 2,500 through September. So let's say it flushes out the same way for the rest of the year. Maybe you're talking 3,000, 3,200, but at least half of what you would have seen in 2009. And again, that goes back to the larger point that things are sort of counter-cyclical to the market. Market goes up, claims go down. What's not discussed in those numbers is not all those cases are even investor cases. FINRA arbitration is also the litigation forum for disputes between financial advisors and their employer. And there's a whole smattering of types of claims that might be involved there, including breach of contract on promissory notes. A lot of people don't realize this, but when a financial advisor switches firms and they send you this letter saying, I'm now registered with this firm because they've got a better platform and they're going to do all these great things for you that'll improve the servicing of your account. What you may not realize is that new firm likely wrote the financial advisor a very large check to induce them to come over. And it's usually structured as a forgivable loan. The firm will pay them, a couple $100,000, depending on the size of or the number of clients that they're bringing over. And if that person stays there for 5 years, which is typical in terms of the agreement, then the firm agrees to not require you to pay it back. But if you leave after 6 months, then you got to give the money back. So what happens is financial advisors switch from firm to firm. That creates litigation over the enforcement of those agreements. Those are typically called promissory note claims, but you also have just garden variety employment disputes. I was promised this, they didn't deliver. I have a hostile work environment. Whatever it might be in terms of just your employment arena, financial advisors have signed a similar provision as to what their clients signed that says, I can't go sue my brokerage firm in court. I've got to go do it through FINRA. So in those statistics, in terms of the 2,500 cases that have been filed this year, I don't know what the breakdown is, but I bet you a good chunk of those are actually employment cases, which suggests that the numbers are even that much further down from the peak, because I think those employment cases, those prominent cases, are fairly consistent. You might see more movement at certain times because of, maybe there's some M&A happening where firms are acquiring other firms and you got a bunch of guys jumping ship because they don't want to be at the new firm or what have you. But for the most part, those types of disputes, the employment stuff, the promissory note stuff, is probably pretty consistent. The big fluctuations are going to be in your customer complaints. So again, obviously those numbers suggest that we're at sort of a low point. And I think that's because last year the market was up 30%. So even if you're not performing in line with the market, you're probably not doing anything about it. You're probably not calling a lawyer. The other thing that was broken down in the statistics that FINRA published, which I think is of value to people in terms of, what should I be on the lookout for? Okay, I'm not up 30% last year. Maybe that's a red flag. Maybe I should, even though I made, some money last year, maybe I should be taking a closer look at what's going on in my portfolio. Now, what should I be on the lookout for? And so FINRA has broken down, here are the types of claims that have been filed. The most common of which is breach of fiduciary duty. We've talked about this in previous episodes, but generally speaking, I would argue that financial advisors do have a fiduciary duty to their clients. brokerage industry would certainly disagree with me on that point, and that's often litigated at hearings in terms of whether or not that duty exists. But I would say that 100 times out of 100, investors certainly think it's there. I think in the relationship between an investor and their financial advisor, the assumption, whether or not the broker would admit it, is that the broker is looking out for their best interest. That he's making a recommendation that is in my best interest and not the financial advisor's. And so that's why I think you see the vast majority, or the number one claim, is a breach of fiduciary duty, where the investor is arguing, he had this responsibility to look out for me and he didn't. So that's the most common type of claim. The second most common right now is negligence. That one's pretty self-explanatory. Obviously in that context, you're going to be arguing that, here's the baseline for what a financial advisor should be able to deliver in terms of investment recommendations, service, what have you. And my financial advisor was negligent in not meeting that bar. I think typically it would be in the context of making inappropriate investment recommendations, but in terms of how FINRA has categorized it, it would encompass all manner of negligence, whether it be a failure to execute a trade. Maybe you called your financial advisor and said, "Hey, I want to sell XYZ stock." The next day it tanks. You take a bath because you didn't get your broker failed to execute. That would be negligent on their part in terms of what their obligation would be to you. Certainly, if you called your financial advisor and said, "Sell something," your expectation is that they're going to do that. So that would fall into that category of negligence. But generally, it's going to cover any instance where the financial advisor didn't meet the bar in terms of what they're generally required of doing as a registered representative in the brokerage industry. The next most common type of case in terms of what's FINRA's broken down of what's being filed right now are failure to supervise claims. And a lot of these, as we go through them, breach of fiduciary duty, negligence, failure to supervise. I mean, the reality is when we bring a case, we're going to bring a cause of action for each of these. So this might be, the same cases that are falling into multiple categories because, just to give an example, you might be arguing in one hand that your financial advisor in making unsuitable investment recommendations breached his fiduciary duty to you. And you might also be arguing, and the firm has liability as well because they're supposed to be supervising him and making sure that he doesn't breach his fiduciary duty. So that could be the same case. But in terms of the way FINRA broke it out, it's the third most common cause of action that's been being raised right now. And basically it would encompass any instance where the brokerage firm is required to monitor their advisors and make sure they are complying with general FINRA rules, SEC rules, etc. And a customer who's bringing a FINRA arbitration has alleged that they failed to do so. So that's your failure to supervise. Next most common is breach of contract. I suppose a lawyer could certainly make an argument that in making unsuitable investment recommendations or in breaching a fiduciary duty or in being negligent, they have somehow breached a specific contract that the customer has entered into with the brokerage firm. So that could certainly include customer complaints. My firm does not generally break out a breach of contract allegation. I would think, although I'm not sure, that some of those breach of contract claims that again making the fourth most common type of claim being filed with FINRA are those employment stuff that we talked about. The promissory note claims, employment disputes, those would very definitely be breach of contracts because you've got a specific contract that you're talking about. And a promissory note dispute between a financial advisor and the brokerage industry is going to, as an exhibit attached, here's the promissory note he signed. Note said, we're going to loan you this money, and if you stay for 5 years, you don't have to pay it back. But if you do, you're in breach, and you've got to pay it back. So certainly that would be a breach of contract claim. FINRA doesn't break it down specifically and tell me in the statistics that they publish that that's what they're talking about. But I would think that's a good chunk of those breach of contract claims because, again, there's hundreds of those cases filed every year. The next most common are misrepresentation claims, and then the final one is unsuitability. And again, going back to just what we generally do, our garden variety claim is going to include almost all of these except for that breach of contract. It's going to be breach of fiduciary duty, a claim for violation of that. negligence, failure to supervise, misrepresentation, unsuitability. But those could all be the same basic fact pattern, where you've got a financial advisor who's made investment recommendations that were both inappropriate and resulted in substantial losses. And so, obviously in terms of the FINRA statistics, they've broken it down, and, that's the most common all the way down. But again, I think there's a lot of overlap there probably in terms of the cases that are being filed and them arguing all of those violations. The next thing that FINRA does, which I think is great in terms of breaking this out, is to also break it out by the types of investments that are at issue. So if you bring a FINRA arbitration claim alleging that your financial advisor breached a fiduciary duty to you, or was negligent to you, or the firm was failed to supervise your financial advisor, FINRA will also, in their statistics, publish what investments are you talking about. Well, and it might be a whole host of investments, because generally speaking, you can't just cherry pick the ones that lost and go sue your financial advisor and say, notwithstanding the fact that he did great for me in 99 of my investments, in this 100th investment, I lost money. You're typically going to be looking at the entire portfolio and arguing, overall, this investment plan that you came up with was negligent, or you breached your fiduciary duty in making these recommendations, or it was in some way unsuitable. And so you're going to be talking about a lot of different things. I mean, unless you've got a really over-concentrated portfolio in a specific type of investment, maybe then you're only talking about one. But I would say, generally speaking, if you're talking about a full portfolio, you're going to see a couple ones that fall on this list. But the most common one in terms of what's filed, the investment that would be at issue according to FINRA statistics, is just common stock. And I think most listeners will certainly know what that is. I mean, obviously, if you buy a share of Apple and you make an investment, I think Apple's trading at about $117 per share right now. So if you invest $117, you have bought one share of common stock of Apple. And obviously, the fact that common stock would be the most common FINRA claim doesn't suggest you shouldn't be investing in stocks. I don't think that's really what the takeaway that you can make from these statistics. But clearly, you've got investors who are alleging that there are problems with some recommendations being made with respect to common stock. And I would say, based on my own experience, and this isn't something that FINRA breaks down, but those problems might be unsuitability. There's a whole range of common stock. You've got your Apple, which is currently the largest by market capitalization company in the world. But you also have penny stocks, and you have high flying stocks, and you've got Netflix, which is 1 month it's up 50%, and the next month it's down 20%. I mean, you've got high risk and you got low risk stocks. And so my guess is, in terms of the common stock claims that are being filed, they're probably targeting investment recommendations in very high risk common stocks. I don't think should be any takeaway that common stock, it's the number one FINRA claim, so we should avoid that. Not all stocks created equal. Next one is, in terms of most common investments cited in claims, is mutual funds. And I think it's the same takeaway there. Not all mutual funds are the same. You've got mutual funds that are focusing on a high-risk basket of investments, whether it be pharmaceuticals in emerging markets, or tech in a specific area, or what have you. And then you've got mutual funds that are sort of a blended portfolio of the entire market that's trying to reduce your risk and exposure, regardless of what happens in external market forces. And so, I think it's the same there, where obviously you've got claims being brought that have to do with mutual funds, but that doesn't suggest that you shouldn't be investing in mutual funds. They're not all created equal. The next one is corporate bonds. Again, I think should be the same takeaway there. If you're talking about bonds in GE, I think that's a very safe investment. That's an established company. But there's also junk bonds out there that I think may be, the next wave of cases that have been written by very high risk, growth oriented oil and gas companies, whether or not they're the companies that are fracking in South Dakota or wherever. But there was a lot of debt written last year as these companies started raising money before oil prices tanked, and they were paying 8-9%. I mean, that's, there's an obvious correlation between risk and return. So if you've got a bond paying 9% relative to a GE bond that's paying 2%, I mean, which one do you think's the riskier bet? So these claims that involve corporate bonds, I suspect, again, similar to these others, have to do with the high-risk corporate debt that would be out there. Next one is preferred stock. Similar takeaway. Not all preferred stocks create equal. Next one's options. That does get into sort of a different. That one, if you don't know what you're doing, options are risky regardless of. Well, there is maybe one option strategy that would not be considered risky, but you still got to know what you're doing. So, generally speaking, I would not say that there are safe strategies out there. If you're investing in options, you don't know what you're doing, that might be a red flag, particularly if your portfolio is not performing. If you're relying on a financial advisor who's got this strategy and they're telling you it's safe, I would dispute that. I mean, there can be option strategies where you can be better protected, but generally speaking, that options is going to be ramping up your exposure there. And so I think that's why you're seeing claims involved with options, is because again, I think for the most part you can be invested in stocks without rely on a financial advisor, but you don't necessarily have to have this huge background in investing. But options is different. Next two, variable annuities, limited partnerships. This sort of gets into my wheelhouse, frankly. This is what a lot of our cases have to do with, which is these products, and they're both very high commission investments. They're generally illiquid, and what we see is that they're being pushed to retired investors who think that the basic function of the investment is to provide income, but when it stops providing that income, you can't sell it. It stops having any value to you. So we have a bunch of claims involving those, but in terms of the FINRA statistics, that one's a little bit lower down the list. When we get back, I'll go through sort of the statistics on how people do in these claims, because FINRA does publish those statistics as well. But for now, we're going to jump away to some commercials.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.
John Michael Matthews' motto has always been the jewelry of your dreams with the service you deserve. As they get ready to celebrate their